would like to introduce our speaker for the evening. Dr. Ed Yardeni is the president of Yardeni Research. I first became familiar with Ed in 1999 when I was a technology analyst on the sell side. Ed was predicting a recession because the companies were not prepared for the arrival of the Y2K bug. And for you youngsters out there, that's when the computers that used a 2-digit date field would think it was the year 1900 instead of the year 2000 when the clock struck midnight on December 31st, 1999, excuse me. Luckily for us all, Ed was wrong about the company's preparedness. The companies spent millions of dollars fixing the bug, and the date change largely went out without a hitch. But he was right about the recession. The year 2000 bug actually caused companies to pull forward their spending on new technologies, which left an air pocket of capital spending once the challenge had passed. It led to the collapse of the first NASDAQ tech bubble. Over the years, Ed has been right a lot more than he's been wrong. Those who subscribe to his research know his collection of economic data is unsurpassed, and his analysis is always thought-provoking because it's steeped in a lot of hands-on experience. Ed has been the chief investment strategies for Oak Associates, Prudential, Deutsche Bank, and also chief economist for C.J. Lawrence, Prudential, and E.F. Hutton. He was also an economist with the Federal Reserve Bank of New York and held positions at the Federal Reserve Board of Governors. And with that, I would like to welcome Dr. Ed Yardeni.
Clicker here? Yeah. It's a little feedback. You got that? Okay. Hello, everybody. Hello, everybody. Can you hear me back there? Good, thank you. Well, folks, I'm really happy to be here today. I was scheduled to fly out of New York in the morning, and I was watching the weather, and I was really worried that I heard we were going to have a nice crowd here, and I was worried that I couldn't get here. Drove this morning to LaGuardia, and if you've been to LaGuardia recently, it's getting better, but it's a nightmare. And parked my car in the parking lot across from Terminal D for Delta. And then I had to walk about half a mile through the construction site here. And there were floods all over the construction. So I'm happy to report that I didn't get my socks wet, so I continue to march on. And I did finally get here. Then I got here at 10 o'clock in the morning, and I started watching my flight for tomorrow. And my flight for tomorrow was at first going to be 10 o'clock. And then I called up my secretary and said, you know what, put me on the 6 o'clock, because that sounds like I need to beat the weather in New York. So she put me on the 6 o'clock, which was canceled. The 10 o'clock was canceled. So I'm happy to say that they kept pushing me out into another flight. And I think I'll be able to get out here tomorrow at 3 o'clock. So if anybody wants to join me for breakfast or lunch, I know a really great lunch place. It's the Secret Society Sandwich Shop. It's fantastic. And I just had to really restrain myself because they have jalapenos, they have onions, they got bacon. And I said, Ed, you're going to be talking tonight. You don't want to eat all that stuff. So anyways, I restrained myself. The French fries were actually quite good. But anyway, it's nice to be here. It's nice to be in this part of the country. My daughter, Sarah, is in Raleigh. She just moved here a few months ago. She had been a Californian, and she had a bistro in Petaluma, California. And she loved it out there. The weather was beautiful and all that. And then the lights started going out during fires. And Santa Rosa, which is half an hour north of Petaluma, they had a terrible fire. And then she had a bistro, and the local town, you know how the Californians are, Well, the local town decided that they were going to unilaterally raise the minimum wage to $15. I said, Dad, I don't think I can operate with that kind of labor costs. And so she sold it to a bagel shop and she left. So she went, I tried to get her out to New York, and at least to the East Coast. And she said, no, we got some family on my husband's side in Arizona. So she moved to Arizona. I said, it's hot there. And so after a year, she said to me, Dad, it's hot here. And so she left Arizona with her husband and their dog Shrimp, and wound up in Raleigh, where she got herself a great executive position for a hospital chain managing their food system. So she's getting closer to New York, but I think she's going to stay here, so we might actually get closer to her and move down here. It's a beautiful part of the world, and I congratulate you for having the wisdom to grow up here and to stay here. I remember many years ago when I used to market and visit accounts in places like Winston-Salem and all that, it was pretty depressed. But now it's where everybody wants to be, and the weather's nice. And again, I warn you, the only thing that's really bad about this part of the country is we're all coming. And for those of you who are conservative, a lot of us are liberals. So that could start to be an issue. Look, there's a lot of things to talk about today when since we're doing a forecasting dinner. And just to get my thoughts out there, I don't think we're going to have a recession this year. I think we're going to have a slowdown, but a slowdown is kind of going back to normal, 2.5% to 3% growth for the economy. And by the way, that'll be quite an achievement because we have a real problem in this country, and it's really at the heart of my thinking about this year and the next several years. And we have a real shortage of labor, and it's a chronic shortage. For a while there, people were saying, well, it's related to the pandemic. People can't get child care. The kids are home, and they're getting these benefits from the government. But even before the pandemic, the unemployment rate fell to 3.5% in January and February of 2020. And even then, it was starting to be very hard to find labor. But everybody thought, well, it's just a business cycle. The labor market always gets tight at the tail end of a business cycle. But this is really more rooted in the demography. The reality is baby boomers are retiring at a faster pace. The oldest baby boomers last year were 74 years old, so this year they're 75 years old. And the old gray mare, she ain't what she used to be. At some point, you decide that enough is enough. And maybe the pandemic made some baby boomers have some quality time to think about the meaning of life, and maybe it was spend a little bit more time with your family. Wasn't there just a quarterback that played down in Tampa that just decided, maybe it's time to retire? So I think a lot of baby boomers are going through that. The problem is we forgot to have babies along the way here, so that there aren't that many people. We have at best enough people to replace the baby boomers that are retiring. So the labor force growth is zero. The growth in the population is zero, maybe 0.5, but it's close to zero. And so if the economy is going to grow 2.5% to 3%, guess what? It's all going to be productivity. And that's really my happy story for this year and the decade ahead, is I think businesses have figured out that labor shortages are chronic, they're structural, you have to deal with it, and the way you deal with it is to hug your employees every day, tell them you love them, and show them you love them by paying them more. You might have seen that Amazon said they had to raise their minimum pay within the company to $18, giving benefits, will put you through school and all that. So you got to do that, and if you're going to have to pay them more and still stay in business, you're going to have to figure out how to increase your productivity. That's the only way it's going to work. And so fortunately, we live in an age now where technology innovations are phenomenal. And the technologies that are out there have the ability to increase both the mental and physical productivity, manual productivity of workers. And I think that's what has already started. It's actually started around 2015 when the productivity cycle bottomed. It continued to improve in the growth rate of productivity through before the pandemic. And now it's running around 2.5%. It was running around 0.5%. That's a meaningful increase in productivity. I should say it's gone from 0.5 to 1.5 to 2% is what I meant to say. Where is it going from here? I think in the next few years it's going to 4.5%. And that'll be the growth in the economy. And by the way, productivity is magic. If you have productivity, wages can go up. They can go up not just in nominal terms, which they're doing now, and doing no good to anybody because the wage increases are basically keeping up with price increases. But I think once the productivity really kicks in, you'll see wages growing faster than prices, so real wage gains will increase. We're not going to have much growth from just more people consuming more, which is really the way we've been running this economy. Back in the 70s and 80s, the baby boomers flooded in, and they certainly provided a tremendous growth in the population and the labor force. But now we don't have that, and so if we're going to have growth, it's going to have to be based on increasing the real wages of people, of households, of families, of workers. And if you do that, that's a tremendous increase in the standard of living, but that's what productivity does. So the happy scenario here for the decade ahead is the roaring 2020s. It happens to rhyme with the 1920s. And if you think about the 1920s, well, a couple of years before that, there was a horrible war. At the time, it was called the Great War. They didn't know that there was going to be a Second World War. So the Great War was horrible. Millions of people were killed. And then the war came to an end, and the soldiers came back from the trenches. They were all sick and unhealthy, and that might have been why we saw the Spanish flu break out in 2018 and 19, and again, kill millions of people. And then in 1920, we had what they then called depressions. They didn't call them recessions. Recessions, some politicians admit that we don't want to scare everybody. Let's just call it a recession. But back then, they called it a depression. So imagine sitting around Thanksgiving, 1920, with your family. And I mean, that must have been pretty depressing. It's like, what are they going to hit us with next? And what they hit us with is the roaring 1920s. And that was, to a large extent, because of the amazing technological innovations, like the autos, like electricity, like radio, like various drugs, like tractors. I mean, just one technological innovation after another. And we had a boom. Now, does that mean that we have to end this one with a stock market crash and a depression when it's all over? Ask me again, invite me back, and we'll talk about it. But for right now, that's my happy scenario. The unhappy scenario is that it's going to be more like the 1970s. And in the 1970s, we had the great inflation. And in the 1970s, productivity collapsed. We had this influx of baby boomers in the 1970s. They were very well educated. They were like me. I was a young baby boomer at the time, came into the labor market in 78, 79. But we had no experience. And there were a lot of us that were relatively cheap, and productivity suffered. Also, labor unions were very powerful, and they had cost of living adjustments in their union clauses, which meant that any increase in prices immediately got fed into wages. Some companies like GM had a productivity clause, which was just give workers 3% per year because that's going to be their productivity, and that wasn't the case at all. So productivity collapsed in the 1970s, and a lot of bad luck. Well, first of all, Nixon devalued the dollar, and that led to an increase in commodity prices. There was food prices went up. We had two energy shocks. And look, there are similarities between now and the 70s, right? We've got oil at $90. Deere workers recently went on strike and got themselves a cost of living adjustment in their contract. Bad fiscal and monetary policies back then, and now, well, you know, I think that we've seen an excessive amount of fiscal and monetary stimulus. And as a result of that, we've had a demand shock. And the demand shock led to a supply shock. It's not like the supply system just suddenly stopped working. It just got overwhelmed. It had never been stress tested with demand, especially in the goods side. Do you know that used car prices are up like 50% because we can't produce enough new cars, and new car prices are up about 15%, 50%, 15%. Those are the biggest increases in consumer durable prices, and a big part of the inflation we're having right now is in durable goods prices. Durable goods prices tend to fall, not to soar. Since 1995, they've been falling, because durable goods is certainly one of the areas where we've got a lot of productivity, and we figured out how to produce better and better cars and appliances and furniture and all these things more productively and actually lower the price. So I don't think that's going to stay up for very long, and I think you're going to see that inflation actually starts coming down. But meanwhile, we are seeing wages going up, and if they keep going up and they feed back into prices, there is a risk of a wage price inflationary environment. But again, I think that the productivity story is going to prevail over that kind of risk, and I think we are going to start to see that inflation starts to moderate up ahead here. So again, 2.5–3% growth. Inflation on a consumer deflator basis is running around 5–6%. I think that could moderate after a few more months of this. I think it could moderate down to maybe 3–4%. I don't think we're going to get back under the Fed's target of 3% in a long while. Why? Well, one of the consequences of this ultra-easy monetary policy has been that home prices are up 30%. My daughter sold a house in California on a tiny little piece of land that was, she sold for $650,000. I mean, you can huff and puff and blow that house down. It was a dump. And she had a psycho neighbor in the backyard, so she was really happy to get out of there and cash in the chips. I think she made about $100,000 on the transaction. She moves to Arizona, and prices are up like 20–30%, and she's not ready to make a commitment there, so she rented from a company that's basically an institutional investor, and she loved it. It was $2,000 a month, and you had any problem, they send the handy people over, and they fixed it. Then she's now in Raleigh, and guess what? The same company has houses in Raleigh. So maybe some of these institutional investors are behind the increase in home prices. But the reality is we have a shortage of inventory of houses, and the demand has been absolutely on fire. A few months in the pandemic, as a lot of people decided that maybe they didn't want to rent. And now we're pricing a lot of people out of that market, and they have to go back and rent. And so rent inflation is going to be a problem, and rent is an important component of the consumer price indexes. So you're going to have rent inflation picking up, which is why I don't think we have the ability to see inflation coming back down below 2%, and why I think it's going to be more like 3%. But the markets will be very happy if we get any indication that inflation is starting to moderate, and I think we are going to get some of that. So that's my outlook for the economy, for inflation. Some people are worrying about a recession. Well, I will say this, that recessions typically are caused by monetary tightening. When interest rates go up, when the yield curve starts to invert, because the yield curve, the bond market starts to sniff that, if the Fed keeps raising interest rates like this, something's going to break. And the yield curve really doesn't predict recessions, I think. I think what it really does a really good job of is anticipating that, boy, if they just go any further here on raising short-term rates, something's going to break in the financial system, some crisis. Somebody probably borrowed too much at historically low interest rates or relatively low interest rates, and something's going to break. And sure enough, something breaks. We get a financial crisis, and then it becomes a credit crunch. Even good borrowers can't borrow, and then that turns into a recession. I can't see how that's going to happen this year, quite honestly, or even next year. There's over $3 trillion in excess M2. If you take the trend in M2 prior to the pandemic and look at the chart of where it is now, it's about $3 trillion higher than where the trend was taking it. So there's a tremendous amount of liquidity. And you can see that liquidity in corporations. Corporations have $2.5 trillion of cash sitting in their balance sheets. And what are they going to do with it? They're going to buy each other. There's going to be a lot of M&A activity. Record M&A activity last year. I think we're going to set another record this year. So I'm not particularly worried about the stock market. Maybe we don't have a Fed put anymore because the Fed has started to realize that, the easy days are over. You have to start getting ahead of the inflation. Well, they're so far behind inflation, it's hard to imagine they're going to get ahead of it. And I don't see Volcker 2.0, by the way. I don't see the great inflation of the 1970s 2.0. I don't see Volcker 2.0. But I do see the Fed raising interest rates. Over the past couple of weeks, there's been a bidding war on Wall Street. There's going to be 4 rate increases. No, there's going to be 5, 6, 7. And of course, that didn't help the market in January. And the 2-year Treasury note got up to 1.22%. And now it's starting to edge back down. It's like, well, wait a second. Maybe we're getting a little bit too crazy here about what the Fed can do. And one of the signals is in the yield curve. It's like, I don't get it. I mean, why isn't the bond yield over 2% right now? I mean, at the beginning of last year, everybody, including myself, thought the bond yield was going to go to 2.5% at the end of last year. Didn't make it. It looked like it was starting to do it through March, 1.7% last year. And then, bam, it starts coming right back down to 1.1%. Then it goes back up. Some of it might have had to do with the pandemic and variance and the market saying, hey, this isn't over, we got to own bonds. Now look, you really can't call it a bond market. It's a rigged market, okay? People, I coined the phrase bond vigilantes back in 1983. Anytime the bond yield goes up anywhere in the planet Earth, I get a call from a reporter, Ed, is that the bond vigilantes? So last time I had a call prior to the recent environment was 2010. Greek bond yields went up to 40%. Ed, is that the Greek bond vigilantes? I said, sure, of course. But then Draghi said, we'll do whatever it takes, and those yields came right back down dramatically. So the bond market's been rigged by central bankers. And so saying what's the bond market saying isn't really reflective of what the bond market's saying. It's rigged. But we're about to see some change in that because the Fed has committed itself to start raising interest rates. It was really funny. If you at all listen to Powell's press conference, or just go back and read it on the Fed's website, or sign up for our service and you can get it from me. I went back to the speech and I said, I always try to count up words that appear often as sort of a sign of what's on their minds. So I always count up how many times are they mentioning inflation now and back then, and wages now and then. And the word decision appeared 17 times in the press conference. Decision, and it didn't appear once before. And it turns out that 15 belonged to Powell and 2 belonged to reporters. And it was in the context of, we haven't decided that yet. Said, why did you guys have a meeting? I mean, they had a meeting in January, and it's like, they didn't decide that yet. What are you going to do about, when are you going to increase the Fed funds rate? Well, we haven't really decided that, but there's a consensus that we should do it maybe starting at the next meeting. So that's about as close as they got to a decision. How about the runoff? We haven't really decided that yet. How about, once you start, what's the path going to be? We haven't really thought about that just yet. So I think the next meeting in March is going to be very decisive. I think they're going to make some decisions. I think they're going to make a decision to raise the Fed funds rate all the way up to 25 basis points from 0. And I think they're going to punt on the runoff and maybe wait a couple of months on it. So I think all in all, the Fed is definitely in tightening mode. And so we'll see how the bond market responds to that. Maybe my friends, the bond vigilantes, will come back from the dead and start to act up. But there's something funky in that bond market. And the only thing I can really figure out is, look at Japanese and German rates. They're 0. They get excited when they're up 4 basis points, from being negative in Germany. But they're 0. Why is that? They're still 0. And maybe Germans and Japanese investors are arbitraging and say, if we can get ourselves 1.7, 1.8% with hedging costs what they are, let's do it. So maybe that's what's keeping rate. But the question is, why are rates so low in Japan and Germany? And the only thing I can come up with is demography. They're old. They're both geriatric societies. And maybe there's something about societies that as they get older become prone to having less inflation and prone to having low interest rates. As a matter of fact, I have a correlation between what I call the age wave, which is the demographic age of the population. And I run that against the bond yield and the inflation rates. Correlation's pretty good. I mean, it's very smooth. I do a 5-year average. So it's kind of trend. But I think there's something to it. Let me just take a break here and give you a little bit more on demography, because I think it's extremely important, and I'm going to wet my whistle. Okay, here's the punchline on demography. I wrote a book in 2018 called Predicting the Markets. I got to chapter 16, and I wanted to do demography. And as a baby boomer, I'm very self-centered, very much into my baby boomer cohorts and thinking we're the center of the universe. And so I've been doing a lot of work on demography, more or less focused on US, pretty much focused on demography. And it's been very helpful because for a while there, I thought I was very special and unique until I realized there's 75 million other people like me doing the exact same things. And what did we aspire to, the baby boomers? Well, most of us wind up marrying our high school, not our high school, but our high school or college sweethearts, because we thought that was as good as it was going to get. And besides, they were our significant other. We had kids. We actually had this illusion that you could work for one corporation and rise. If you ask a millennial today, do you know what AVP stands for? VP, SVP, EVP? He said, are those new Bitcoin currencies? I mean, are those new cryptocurrencies? They don't have the mentality of working for a corporation and rising in the corporation. It didn't quite work out that way for a lot of baby boomers, but that was the mentality. And you had kids and you moved to the suburbs, and then you remodeled, and you need stainless steel appliances with granite counters. Raise your hand if that's completely different from your experience as baby boomers. But so that was sort of the mentality. But along the way, fertility started to really come down. And if you really want to see where the rest of us are going, you go to Japan. I used to go to Japan, and I visit our accounts back then when I worked on Wall Street rather than had my own firm. And I started to pick up that demographically, they were not unique, but they were ahead of the rest of us. They weren't having kids. The women didn't want to get married. The guys were out karaokeing at the bar all night. Whatever it was, they weren't having kids. So when I got back to the US and I talked to my institutional accounts, I said, I think Japan is becoming the world's largest nursing home. And, and that might have consequences for the growth of their economy, for their inflation, for interest rates. Well, now I think that China is becoming the world's largest nursing home. It is the world's largest nursing home. And that's because the same factors that have driven down fertility in Japan have been driving it down in China. Plus, they impose this draconian, horrible one-child policy in China. So I look around the world trying to globalize my demography work, and I said, well, wait a second, fertility rates are falling everywhere except India and Africa. And why is that? Well, it's urbanization. You know, when you live in an agricultural community, kids have an economic value, and they don't take much effort. I mean, Hillary was right. It takes a village to raise kids. So you have all these kids running around, and then, they're considerate enough so that they can help you with a harvest, they can tend the goats, and they can feed grandma and grandpa a bowl of something over in the corner. Once you urbanize, kids are just a pain. You don't like their friends, they're noisy, they don't listen to you, they won't help you with the crop, they won't tend to the goats, and they're just expensive. So why do they only have one kid per family in China? Why is the Chinese government begging, pleading with people, please have 2 kids now, 3 kids now, and they're not doing it because kids are expensive. And so demographically, what we're seeing is the voluntary self-extinction of the human race. AOC should be very happy. Climate activists should be very happy. We're going, okay? We're going to leave the planet to the animals and to the plants. But the reality is, if we're not going to have kids, then we're going to see populations decline. We're seeing that here, though the United States still has one advantage over a lot of countries. People actually want to come here, both legally and illegally. So I think that may take some of the pressure off of us. But demographically, I think the world is facing a shortage of working people. So around the world, we're going to see technology booming as people use those kind of innovations. So economy is going to grow, slower pace. It's going to be based on productivity. Inflation should moderate. The supply chain disruptions should start to ease. One of the big problems has been getting chips for trucks that are being parked in the in the Louisville parking lot of the Speedway. Several thousand cars there, just trucks, just waiting for the chip. And apparently Ford said today that they're finding some chips after all. Let me conclude with some discussion of the stock market, and then we'll open it for a little discussion. So where's the stock market going on in all this? I think it's going to go nowhere fast this year. It started out around 4,800, ended up last year around 4,800. I think it's going to end up this year around 4,800. Valuation multiples are elevated, especially for the mega cap 8. We used to call them fangs and fangmums and all these other things as we went from 5 to 6, 7, 8 of these things. Let's just call them the mega cap 8. And the mega cap 8 have had a very high valuation multiple, and they're all over the place now. Facebook was a huge disappointment to Mark Zuckerberg. I think it's great if people stop using social media, especially Facebook. The stress level in this country might come down a lot, so I got no problems with that. But it is a 25% hit to his wealth, so he may have to sell the Hawaiian compound. We'll see. But then again, Amazon announced, and its return was fabulous. I have a daughter in the University of Delaware. We visited her a couple of weeks ago. Went on a Saturday, and we're driving up and down 95, and I'm counting the Amazon Prime trucks that are going up and down the roadway. I mean, I'm kicking myself. I should have just bought the stock. I mean, you know where the truck drivers are that we can't find? Amazon's got them all, okay? And for the life of me, I keep ordering stuff from Amazon. We're probably Amazon's 5th biggest buyer. At least it feels that way in terms of all the packages that we get at home. And it all arrives like the next day. So where is this supply disruption? And this notion that supply disruption has nothing to do with fiscal and monetary policy is nuts, because look at the West Coast. We have record imports in the United States. Where did they come from? How do we have record imports if there's supply disruptions and we can't get stuff? We're getting it, we just can't get enough of it because the demand has just been so off the charts. So we got all these ships bobbing up and down on the West Coast, but they're getting offloaded. Just more of them coming because we keep buying. But I think it is going to start slowing. I think the pent-up demand is going to start to moderate. So I think the stock market will hold its own, maybe go through this rotation. I particularly like energy, financials, and if you can, and I like beat up technology companies because I think they're going to generate great earnings growth. Why energy? The climate activists have been very active and have been very successful in getting companies like Exxon to back off on capital spending. Now think about it. The energy companies, the fossil fuel companies, saw their prices go up in the past, so this is great, let's find more of it. Now the prices go up and said, this is great, let's not find more of it. And so we're going to have this problem in the energy market, which is a good thing for the fossil fuel energy companies for now. And those stocks will continue to outperform, I think. Financials, I think the banks are going to continue to do very well. I think loan demand is coming back. I think the economy is going to be growing. The credit markets are going to get a little tighter, so I think there'll be more opportunities for banks to make loans. Technology is, look, I would look at your portfolio and ask yourself, is every one of these stocks I own a technology company? And what I mean by that is they don't have to be technology companies or make technology. You want to make sure that your companies are using technology to increase their productivity. And I think that's going to be what keeps things going. So 4,800, mostly because of valuation, mostly because the Fed's going to be in our face for a while. Don't fight the Fed. A stock picker's market for sure, in my opinion. But then I think the bull market continues going into the next couple of years. Let me take you for a real quick run through some charts. And let me see, what's my time situation here? 7:48. So I'll run you through the fastest run through charts that you've ever had. If you want these charts, just go to yardeni.com and I think the second section has got presentation charts, and look for Zoom charts, and that's what these are, and we update them on a regular basis. So I didn't say much about the pandemic. I'm assuming that the worst of it's behind us, or that it will be soon. If you look at this chart, you can see the new cases, and with Omicron, the new cases went insane. Before Christmas, my wife and I, we had a family gathering down in Atlanta, in Alpharetta, for those of you who know where Alpharetta is. A booming area, fabulous area. Anyways, my daughter, who happens to work for my company, it's a little bit of a family business. So she's sort of a mini-me. She's writing about the Fed. So she's got her husband and two kids, my two grandchildren down there in Alpharetta. And then Sarah came over from Raleigh with her husband. And then my wife and I came down with our two college kids. That's why I'm still working for a living. So I got two college kids, one graduating from Quinnipiac, the other one University of Delaware. They did not give me a discount for the Zoom classes. But at any rate, David and Laura came down, and Sam came down. So everybody's there, and we're having a grand old time, sitting in the car together and the whole thing. I got my 2 shots and the booster, and my wife the same thing, and Sam had that, and the others all had their 2 shots at least. Anyways, we come back home, and we get a call from Melissa. We've all got it. We've all got the COVID, and they survived it, and they're doing fine. And then Sarah and her husband Emery, they got it, and David and Laura got it, and we're sitting in New York. We're coming back from the airport, and David and Laura are in the car, and Sam's in the car, and I'm in the car, and Valerie's in the car, and Valerie and I and Sam do not get it. Maybe it was the 2 shots and the booster, but anyways, so hopefully Omicron is the last wave of this thing, and I guess you have to believe that the herd immunity kicks in, or that we're just going to have to live with the damn thing, and that we've got, between vaccines and medications and therapeutics, we can deal with it. So there's my real GDP forecast right below it. The V-shaped recovery is what I've been talking about for a while. I think it's going to slow down this year. Nothing lasts forever. I'm going to skip a few things real quickly here. And if I hear talking in the back, I'm going to talk for another 3 hours. I used to teach Sunday school. All right, this is a very important chart here. This productivity chart, the red line is the growth in productivity. And you can see there are cycles in productivity. And some of you might have thought, 4.5%? What was in his salad? I mean, how are we going to get that kind of growth? Historically, that's the kind of growth we've had during productivity booms. And I think this one's a layup. I think there's a shortage of workers, and we got the technology that it can increase productivity, it's going to happen. And that's great for technology, obviously. What else did I want to? This is the inflation chart. The inflation chart shows you the components of inflation, and consumer durable goods inflation has been a big part of our inflation. And again, you can look at the chart and see that historically, consumer durable goods inflation tends to decline, not increase. Let's see. That's the yield curve. There's lots of other charts. I'm going to have to come back tomorrow, and we'll have to do this again. Why don't we open it up for a little discussion? Thank you very much. We can use in response to questions. Does somebody have a mic for? We have a lady over here. Okay. Should do it.
Because you mentioned the company is going to be stagnant moving forward in the U.S. or globally. Is there an issue with the way we measure productivity?
I could barely hear that. What was the question?
Is there an issue with the way we measure productivity?
Oh, is there an issue with the way we measure productivity? It's a great question. Look, any data, pay attention now, any data that supports my story is really good data. Okay? And if it's not, it's going to be revised to show that I was right, or there's something really wrong with it. And look, productivity is it's a tough number to get. It's a tough number to measure. And one of the things about that chart that I showed you before is there were two series on there. One was the productivity growth rate, and the other one was the inflation-adjusted growth in compensation, which is the broadest measure of wages, salaries, and benefits. And the correlation, as you might have recalled, and I could show you again, was very tight. And I did an graduate degree in economics, and it was a waste of time. The only thing that made any sense to me was microeconomics, particularly the notion that in a competitive market, productivity does trickle down to workers. Workers do get paid their productivity in real wages. Productivity is what drives our standard of living. I just wrote a book called In Praise of Profits. And it's basically a capitalist manifesto. It's dedicated to progressives, to lefties. I hope they read it, and I hope it makes them a little less left. But the basic idea is that the profit margin, the profit motive is what motivates entrepreneurs to come up with new technologies that increase the productivity and allow us to do things, produce better goods and services at lower prices. So what we're seeing is that relationship is still holding up. And we are seeing that real compensation has been growing at a faster pace in line with productivity. So if I'm right, and this is just the beginning of a productivity boom that continues for the rest of the decade, then we should be able to see it confirmed by real wages. So the fact that the two series that come from completely different kind of sources are corroborating one another gives me some confidence that the data is working, that it makes sense. Thanks for that question.
Thank you.
As a tail-end baby boomer, I share a lot of your views, but I don't understand the call on financials, because based on what you're saying about the Fed, and based on the potential disruption to some of their higher margin businesses,
Right.
I just, it's hard for me to buy them.
All right, so the question is why overweight financials in this environment? Look, there is sort of this knee-jerk trade that's been going on, that as the bond yield has been going up, At least when it decides it wants to go up, that's when financials tend to outperform. But financials cover a lot of territory, and it's banks. A lot of the banks do traditional banking, and they have investment banking. One of the areas where I see a tremendous growth potential, where I see tremendous growth for financial earnings is in M&A activity. We had record M&A activity last year. I think it's going to set another record this year. We just started the year. It's just January. In January, M&A activity is $150 billion, twice what it was January a year ago, and it is all technology. So there's, that's why I'm saying if you're worried that the Fed put is kaput, that we're not going to get the Fed put anymore, because the Fed, look, we've had 4 tapering tantrums in the past, 3 tapering tantrums. This is the 4th. What's different about this one is the Fed can't say, oh, you're my boobies, you're upset in the financial markets. We'll back off. Okay, they can't do it this time because they got a serious inflation problem. So I think the Fed is going to have to tighten in. So the Fed put for the stock market is gone, but the CFO put is definitely there. They're sitting in $2.5 trillion in cash. They were able to refinance most of their debt at record low interest rates. They raised $1.5 trillion during the pandemic. So there's a tremendous amount of liquidity, and maybe that's not $3 trillion in excess cash that I'm telling you about in M2. And I think that's going to drive M&A activity. Look, anything that you can add a tech to, I think you want to overweight. FinTech, overweight. MedTech, overweight. I'm not telling you that the financials as you know them today are, I think they're going to, like everything else in our society, they're going to evolve and become, there's going to be a lot of M&A activity, they're going to use technology and all that. Nobody's asked me yet about Bitcoin and how does that fits into the whole thing. Bitcoin is digital tulips. Any questions on that? Look, it's a great analogy, really, if I do say so myself. Why? Because when they had the tulip mania in Amsterdam, it was in Amsterdam, and people went to sleep at night. They didn't do it 24/7. They didn't do it worldwide. That's what's different. So when people ask me, where's Bitcoin going? I said, it's going to 1 million and then it's going to 0. I mean, who the hell knows? It could be anything, but maybe it's over. Maybe it's kaput. We'll see how that plays out. I mean, certainly, who's kidding who? You think central banks are going to let these cryptocurrencies survive? Please. And besides, they're associated with so much illegal activity and corruption. It's like, let the central banks handle it and do their illegal activity and corruption. They do it better and officially.
My question is on inflation. You and the administration and the Fed all think this inflation is just going to peter out. My experience is the opposite. It just accelerates. Look at Germany after World War I. Look at Argentina. Look at Brazil. Look at Greece. Look at Italy. Look at Turkey.
Sure.
Somebody has to step in and do something significant to stop inflation.
Correct.
It's just not going to peter out.
Yeah. No, that's a very good point. History shows that once inflation accelerates, it can become hyperinflation. I mean, look, we didn't have hyperinflation in the 1970s. We had high inflation. It lasted for a long time, and we wore win buttons, and we did all kinds of dances to try to bring it down. But at the end of the day, it was just a good old-fashioned recession caused by Paul Volcker that brought inflation down. And but it stayed down. And why did it stay down? Well, the 4 Ds is what I call them. I've been talking about the 4 Ds since the early 80s. One of them is globalization, which starts with a G, so I need a D. My wife is French. I said, honey, what do you got for me? I need a word for globalization. It starts with a D. She said, détente. So I said, mais oui. So détente. Globalization, historically, inflation tends to be a wartime phenomenon. And when wars end, you get globalization. You get peace times. Countries start trading with each other, even with their enemies, former enemies. You get a lot of competition. It's the microeconomic model of competition, again, which makes sense to me. And so you get deflation. And you can go back and look at the CPI. I don't have the chart here. The CPI going back to 1800. We have it all the way back then. And you'll see that the spikes occur with the War of 1812, the Civil War, World War I, World War II, and the Cold War. And what's different about this time around is we didn't have central banks that just completely overwhelmed the system with liquidity the way we have now. So things have changed. Things don't stay the same forever. But another factor is technological disruption, disruption. The technology is inherently deflationary, in my opinion, and we've already discussed a lot of what should drive that. Then there's demography, which again, we've kind of had a little discussion about. And then debt. Debt used to be very inflationary, but at some point when people and companies and others are so indebted, it loses its stimulative impact. And if you try to maintain very easy monetary conditions, you get more zombies. The debt actually allows companies to borrow more money at low interest rates, and they survive, and they create more deflation because the market doesn't adjust by having these zombies get buried. Those 4Ds are still out there. What's changed is the amount of fiscal and monetary stimulus that we've had for the past couple of years, combined with some supply-side disruptions like semiconductor chips. So, yeah, you're right. I mean, history shows that once inflation gets going, it tends to accelerate. And there's historical examples like Weimar and Zimbabwe and others where it becomes out of control. But that's what forecasting is all about. You look at history, you look at how history is relevant or not relevant, how things are different, and you come to a conclusion. My conclusion is that it's going to dissipate as supply disruptions ease off, and we have some macroeconomic indicators for monitoring that. And sure enough, they're starting to come down, so it's got to be good data, obviously. Then we're not, I presume that when Joe Manchin says that BBB is dead, that we're not going to get another round of fiscal stimulus, and the Fed is now moving towards a tightening mode. I mean, I don't know what's taking them so long to get going, but they've already impacted the financial markets. The 2 years gone from 0 to 1.0%, so the financial markets are already, I mean, if I was running the Fed, I'd just increase the Fed funds rate by 100 basis points on March and say, see, I did it, you expected it, you got it, see you in 6 months. I'm taking the rest of the next 6 months off. Get out of my face. Anybody else? Going.
Thank you. I think we all appreciate what you're saying about corporations being well prepared for rising interest rates because they've pushed their debt out at lower rates. The federal government, we got $30 trillion in debt.
Right.
And as rates go up, that's going to increase our interest costs. Can you talk about the implications for the budget process and discretionary spending?
Yeah. I have something I want to announce, and that is we are never, ever going to pay off our debt. Okay? Anybody disagree with that? I mean, people from time to time ask me, when are we going to pay off the debt? And the answer is we haven't, and we're not. Now, you have to realize, as I'm sure you do, that I have to tell you, I have a lot of accounts, and some of them are manage money for wealthy families or just large portfolio manage, people, families with a lot of net worth. And especially when the market is down, my accounts call me up and said they're getting their accounts beating them up about why are we in the stock market? So I said, well, what do they want to do? They said they want to get out of the stock market and they want to get into the bond market. So yeah, but look how low the yield is. I said, they just feel safer in the bond market. So I said, why do they want to get out of the stock market? Because they don't like all the government debt that's out there. So they want to buy it? I mean, somebody's buying this stuff. Okay, now for a while the Fed was being a major contributor to that, so we're going to stress test the system. But you make a very good point is how can you come up with a scenario where interest rates go up meaningfully without that obviously clearly driving up, making the deficit even larger, compounding it, and causing a real calamity? And the answer is that is the doomsday scenario from an economic standpoint. But then if you look at Germany, you look at particularly Japan, you can see that demography may play a role here. I mentioned that we are seeing the voluntary self-extinction of the human race. If that's the case, believe it or not, we may actually have the right fiscal and monetary policy for dealing with that. I know it's crazy, but I mean, that's what the Japanese have been doing. They're providing zero interest rates, and the government owns about 60% of, the central bank owns about 60% of the government debt. And productivity is pretty good there. Life isn't bad. Economy is doing okay, but they have a record amount of debt, much more relative to their GDP than we do. And so I don't, look, I should have revealed to you that I had a happy childhood, so I tend to be an optimist. And I'm not, I'm watching it, but right now I'm more into the roaring 2020s than I am into, $30 trillion is going to be the end of us. Thanks for the question. We got time for one more or two more? You tell me. Two?
Yeah, a couple more.
Okay.
You talked a lot about the U.S., just thoughts on international.
I need to be able to hear this, gentlemen. Go ahead.
So talked a lot about U.S., just thoughts on international moving forward.
Oh, I've been I should really show you a chart on that. Oh, there it is, the red. Let me see. Take a look at this chart if you can make it out. Again, they're all going to be on the website at yardeni.com. But it shows you forward PEs for various segments of the market. The mega cap 8 account for 25% of the S&P 500 market cap. The mega cap 8 account for 50% of the growth index of the S&P 500. The mega cap 8 have been extremely important in investment styles. And the three main investment styles are large caps versus mid caps, small caps, mid caps. They are growth versus value, and they are stay home versus go global. Stay home meant something different before the pandemic, but just overweight the US. And so I've been preaching that you want to stay home in the US, overweight the US. And a big part of that has been the mega cap 8. But now, as you see, their valuation multiples are coming down. I would still stay with the US. I think Europe has shot itself in both buttocks, as Forrest Gump once said. You may have to edit that out of the movie here. But the Europeans have had particularly aggressive climate activists, and they've been shutting down nuclear reactors, coal plants, gas-fired plants, figuring that they would make their contribution to cleaning up the air. But meanwhile, they're begging the Russians to sell them more gas so they can burn it in Russian gas in Germany. Go figure. But their energy costs have just gone sky high. They are doing a horrible job of the transition from dirty to clean energy. And so I think that's a disaster for the European economy. So I'm not particularly thrilled about investing in Europe. China had a terrible year last year. I can't morally recommend investing in China. It's a criminal regime. The Chinese Communist Party is an autocracy. It's brutal, and as we've seen, it's just bad for business. because they've had a run there of capitalism and kind of pilfering some of our technologies. And now they decided that they're wealthy enough, rich enough, that they don't need capitalism. They can go back to Maoist economic principles. And I just don't think that's good for investors. So I have no interest in investing in China. And I will no longer be able to visit China, clearly, based on what I just said. But that's the way I feel about it. But there's opportunities in Latin America. India probably has opportunities. But for all of the crazy things that are happening in this country, I still think we got the most diversified, best businesses, the best technology. And when you look at where we outperform, and we just did a study on this, you find that across all 11 sectors of the S&P 500, the U.S. has outperformed the foreign sectors hands down since 2009, and I think that continues. So we'll stand up now, we'll have the honor guard come back, and we'll do the pledge. It's a great country, America. We'll end on that note. Thank you very much.
Thank you. Thank you, Dr. Yardeni. We have a small token of our appreciation here for you. I will. It is not a U.S. long bond. Thank you. Finally, I'd like to announce the winners of last year's forecast dinner, and please be sure to fill out your forecast cards. You can leave them on the table or drop them in the boxes outside in the hallway. And you too could win a $50 Amazon gift card. For last year's winner, for the S&P 500 guest was Robert Moyer. For the VIX, Brent Morse. The 10-year yield was a tie between Chip Huey and Javier Maya. And we have a double winner for Javier, who also got the crude oil estimate correct. So please be sure to fill out your cards, and good luck to you for next year. We hope to see you again in 12 months. Thank you so much for coming.